Monday Futures Market Outlook for April 18th, 2011. This is Patrick Sresna. Anybody that would like to try a free trial to the eminisource.com trading room, 5-day complimentary memberships are available on the site. As always, we start off with a chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on the chart, it does a very good job to depict the bull and bear market cycles the market has gone through. Ever since the bottoms of the summer of 2010, we've been looking for a bullish rally higher, and we've now achieved many of the upside targets which we were looking for in that 1340, 1380 area on the upside. And while we certainly cannot rule out the possibility that the next couple of weeks or month even has further strength in the market, but at some juncture going into the third quarter of the year, we're anticipating there to be a corrective pattern within the S&P that could easily see even a 10 or a 20% market correction. We don't necessarily believe that that will be the beginning of a bear market, but rather simply the process in which the market trades up or down. At this stage, therefore, we believe that there's only marginal upside benefit to remaining with the market. Just to review our key market observations, we remain intermediate bullish on the market, but we've already reached those upside targets. The US dollar continues to keep its downtrend in place, and from an intermarket relationship perspective, that means that the current trends in indices, commodities, and bonds can actually continue. We've been anticipating that market top along this 1340, 1380 area. We still believe that the market has a chance of actually still making it up into those target zones one more time, but at some juncture we are looking for a topping formation to develop. If the S&P for whatever reason was to break below 1290, 1300 on the downside over the upcoming week or two, we have to at least start considering the possibility that we just saw an S&P double top up along that 1340 area. But at this stage, it's still too early to be making that kind of a conclusion. And again, we anticipate the second quarter to represent a topping formation and a third quarter market correction and an asset rotation on an intermarket level. Next year, when we take a look at the daily charts in the S&P 500, you can see that double top that we were just looking at. Essentially, right along that 1340 area along the upside, we had a test and subsequent corrective pattern. But really at this stage, this little move downwards here could just be a flagging formation before the S&P again attempts to make a higher high push on the upside. I think that this scenario is still viable and must be considered the path of least resistance for the S&P to go on the short term. But in that blue box or anywhere right around these higher levels around that 1340, we do believe that the high of the second quarter will come in there before the corrective pattern. So even though we have that bias for the market to slightly go higher here, we're not very optimistic about a sustainability of any rally. If for whatever reason we see a break of the 1290 level on the downside, especially if that market accelerates in any way down toward the 1250, 1260 area on the downside, that would be the scenario where we'd have to seriously consider that we saw a double top on the S&P. But so long as that 1290, 1300 level holds, again, trade higher. Next year, I want to take a look at the E-mini NASDAQ 100, and right up along here we saw the NASDAQ roll over off of around the 2350 area and consolidate. There's still a chance as that S&P rolls up if the NASDAQ may as well, in which case the NASDAQ may very well head right back up towards the 2400 level. But there's no denying that there is a predominant weakness in the technologies, that this was a real leadership group during the entire rally off that September low, and we're seeing more and more distribution occurring within that technology space. And so that really is something that we're using to confirm the fact that the markets should be topping out along here. There simply is not a lot of stocks. There's actually less and less stocks that are participating in these rallies, which is very customary along a topping formation. Next year, I want to take a look at the US dollar index futures, and the US dollar here has broken that 75.50 support line on the downside and is really weakened down to the 75 level. We're seeing a little bit of hesitation here, but really the window is open for the US dollar to continue to weaken, maybe even as low as the 74, 73.50 area. In order for that US dollar to weaken further, it would actually mean that the euro would have to break out above its 145 level. There is a chance that if the euro fails at 145 and reverses back down, that the dollar actually bottoms off this exact level where it is at 75. But really watch that euro. If the euro breaks out on the upside, the US dollar could very easily work its way all the way down to 74. I think in the bigger picture, the market tops on commodities and on the S&P 500 will all come in unison with a US dollar bottom. So while this US dollar continues to break down, it continues to support the idea that everything that's been in place can still remain that way for a little bit longer. When we take a look at copper futures, you can see that the predominant trend that's been higher in copper is also getting a little bit choppy. Last week we were talking about that nice breakout attempt on copper, which could have seen a breakout above that blue line actually follow through to 480 to 500, and in spite of US dollar weakness, copper just came right back and got distributed off a rejection off that 455 level. Really at this stage, copper again is feeling very toppy, very heavy, and even but it doesn't necessarily mean that copper has to have a very steep decline until the US dollar has put in its bottom. More or less, I would treat copper now far more range bound, and will most likely chop to top to bottom ranges and eventually break down when the US dollar starts to rally. Next year I want to take a look at gold futures, and we had that bullish breakout we were talking about 2 weeks ago, and now gold is continuing to follow through. We were targeting around that 1480 area. It's clear that we broke that, expanded the target to include the round number of the 1500 level, which is the first blue box, where the first initial target on gold will be, but there is a bigger picture measured move that even targets 1550, even 1580, and so long as the US dollar weakness is in play, and so long as silver continues this massive rise, then gold will continue to be accumulated, and you'll see this entire trend persist, and we could even see further highs on gold. At some juncture, gold and silver will go through a very significant market correction, but there's no indication that that top is in place at this moment, so the trend higher remains to be the path of least resistance. Next year I want to take a look at crude oil, and crude oil went last week through a very dramatic reversal off that 113, 114 area, wiping out a better part of even $7, $8 on the downside within just 2 days, but we're already seeing crude oil working its way back to 110. I don't believe that crude oil has done the upside move yet because of that US dollar weakness and the strength in other commodities. A number of measured moves continue to target 115 to 120. It's quite possible that crude oil will still again attempt another push up in towards 115, 120 on the upside. But again, at some point when the US dollar bottoms over the next month or more, you're going to see some major tops come in all those commodities, whether we're talking copper, gold, or oil. But right now, again, the path of least resistance is higher, and there's no indication to begin short selling or trying to profit from the downside moves yet. So right now, the trend higher is the only thing that's in play. Finally, I want to take a look at the 30-year Treasury notes, and we continue to see Treasury bonds banging out a trade range bound market bottom. These 30-year Treasury notes really now represent where the next opportunity will lay for our buying. They mostly an anticipated play on inflation expectations, and really I don't see Treasury bonds breaking out on the upside so long as commodities remain in the uptrend that they've been in play. But at some point when commodities begin their correction and ease inflationary fears, at that moment we could see the 30-year Treasury note have a rally even up to the 126, 128 handle on the upside. That was your Monday Futures Market Outlook. Thank you for joining me.